thank you everybody for coming to the webinar today. We appreciate you coming out. Today we're going to be talking about e-commerce accounting errors and mistakes and how businesses might find themselves in situations where they're making these mistakes or having errors in their accounting that they might not have known about, and then how to potentially avoid these situations before they even come up. So to introduce myself, I am John May, a little bit of a jump scare there for you. I am the Video and Engagement Manager here for Webgility. I've been with Webgility for just about 3 years now. I started as an implementation specialist, which gave me a lot of intimate knowledge on the product that Webgility offers and specifically knowledge about the accounting and e-commerce ecosystem as a whole. So today we're going to, just as a quick agenda, go over what constitutes an accounting or an e-commerce error as it relates to accounting. So talk about the different types and causes of accounting errors specifically. And then we'll move on to some real world examples, what the issues might look like in the real world as it relates to an actual business, and then some solutions on, again, how to avoid falling into these traps to begin with. And then we'll end at the very end of the session with Q&A with our partner Seth David, who is the chief nerd, as he would like to call it, of Nerd Enterprises. He's a brilliant person when it comes to e-commerce accounting. And so if you have any questions related directly to your accounting processes or your experience in e-commerce accounting, that is definitely the time for those questions. All right, and again, to dive right in, so what are errors in accounting? What does that mean? And what do these errors come from, and what causes them? So to define all these errors, I just want to preface this with sort of the note that generally when it comes to accounting errors, we're talking about errors that are essentially, as you'll see it down here at the bottom, caused by human error. So with data entry, with any postings or anything that you're moving data from one place to another, there is always the chance that human error will cause an issue in your accounting. So to go down the list here, the first one we'll start with is data entry. This is probably familiar with everybody. It's the human error due to a manual process. So whether it's your inventory or order posting or expense calculating, reconciliation, any of that, since it's managed by a human generally most times, there is the chance that something is going to be input incorrectly. And that's generally what that catch-all of data entry means. Now, errors of omission generally means that you're forgetting or missing posting something. So still, again, kind of related to the data entry in that a human is making this error, but if you forget or miss a posting, that's an error of omission. An error of duplication would sort of be the opposite end of that spectrum, where you are posting something multiple times. So you're posting a refund twice, or you're posting an order twice, so that total is incorrect because it is duplicated. An order of transposition would be the flipped or reversed totals. So if you're dyslexic in any way, something like that, where you're putting a 1 where a 0 should be, or flip-flopping some numbers. Compensation would be an incorrect payment to like a vendor or an employee. And then an error of principle generally refers to GAAP violations. So generally, the generally accepted accounting principles is what GAAP stands for. So basically the pillars of accounting that the U.S. sets a standard for. If you kind of violate one of those principles, that is a error of principle. We do have a lot of information on the GAAP principles. So if anybody would like to see another webinar or some long form content specifically around GAAP, that is definitely something we can always do. That's a huge conversation, generally a lot more complicated than what can be fit in a short conversation though. An error of reversal is generally referring to an error of commission. An error of reconciliation is when the deposits and statements don't match. And then an error of closing is generally referring to making a change to your journal entries after you've already reconciled. And then I want to drive this point home. The common denominator here is always going to be that human error. It is kind of going to be a theme throughout the rest of this webinar. So just if you take anything home, it's that the human error here is the element that we kind of want to control as much as possible. All right, and we'll move on to some actual real-world examples of how this affects an organization or a business, and then some scenarios and how you might be able to avoid falling into these traps. And since we already talked about errors in accounting and how they relate directly to the accounting process, it's also important to look at how, as an organization or a business, how those errors can snowball or affect the organizational or the foundation of how your business runs, and how they can lead to the mistakes that are real world impactful for you. So to get started, we'll talk about inventory specifically. So in this scenario, we'll assume that you are either manually tracking your inventory or not tracking your inventory at all. And when talking about inventory, it's super important to understand that correctly tracking your inventory or having a process for inventory tracking is a good way to gauge your performance as a business. It allows you to keep up with multiple channels. If you have products that are selling on multiple channels, you'll be able to ensure that you're keeping the correct amount of inventory. And what this means is if your inventory is too high, you are wasting your capital as a business and wasting resources on keeping those items stocked because they're not maybe selling as well as you'd like to, or because you've just overstocked them. Now, if your inventory is too low, you are running the risk of stocking out or losing sales because of that. So if you aren't in the know as to how much you should be stocking a certain product or a certain level of inventory, people are going to buy it out, and you're going to be a lot more reactive to that. So you're going to have to react to people selling out your product and then order more in that moment, where if you were forecasting your inventory correctly, you could preemptively order enough stock or just the right amount of stock across the board so that you're not running into either, again, stocking too much or stocking too little. This also leads to poor decision making based on the inaccurate data that you have, or just the lack of data altogether if you don't track your inventory at all. So moving on to sort of a real world experience here, we'll use Jared as an example. So we'll say that Jared runs a clothing business and he has multiple Amazon and eBay stores. So he has products between both those Amazon and eBay stores. And up until this point, Jared has been tracking manually his inventory between his sales channels and QuickBooks. So what that means is he's running into an issue where he gets a large order, maybe because he's gone viral on social media and people are kind of rushing to order his product. And he is having an issue getting those orders fulfilled because he's stocking out. So he's having to delay fulfillment on those orders, maybe even stop selling the product temporarily altogether. And that means that he's losing money, he's losing time because he's having to go back to his supplier, order more inventory, and then start to fulfill or sell the item again. And that's just obviously not an efficient process. So one thing that he can do, or in this case that he has done, is he integrates his sales channels across the board. So his Amazons, his eBay, and his QuickBooks all together have been integrated with an inventory management system. There's a lot of these that are out there. Webgility does offer one ourselves, but any inventory management system will generally have this capability. And you can use QuickBooks as your main inventory or master inventory. And when new shipments come in, you sync everything to your QuickBooks and make those adjustments to inventory in real time. So just to dive deeper into what that looks like, an order comes in from Amazon or eBay, and they push that order automatically directly into your QuickBooks, which adjusts the inventory inside of your QuickBooks. And then whenever you get new batches of inventory, you just tell QuickBooks what the new inventory value is, and it pushes those updates back to the store. So it creates an ecosystem where whenever somebody makes an order, it deducts the inventory correctly, and whenever you get inventory, you update it and it syncs everything. So that allows you to stay ahead of those big changes. It allows you to keep inventory synced across all of your channels, so you're not having to go into each individual store and sync everything individually. The next thing we'll talk about is sales reporting, closing, and reconciliation. So one thing that a lot of businesses find themselves in trouble with is kind of doing these things inconsistently. So reporting any accounting changes, whether it be making sure that you're reconciled at the end of the month or whenever you do your reconciliation, making sure that all of your orders have been posted in a timely manner, and then reporting on all of those sales to understand where your business is at is super important as well. So if you're not already closing your books regularly, it is something to look into. It gives you, again, valuable insight into the performance of your business as a whole, and just getting into the rhythm of having a schedule for downloading and posting your orders, and then reconciling at the end of the month or at the end of the quarter just gives you kind of a cornerstone or a baseline for making sure that everything is correct and financially sound within the business. And if you don't have a regular cadence, or if you fall short in some of these areas, you run the risk of having errors in your financial reporting. So if you're looking to procure financing from either a lender or an investor, you might run into issues with your financial reporting because they're going to ask for documents, they're going to ask for receipts on how your business is performing. And if you can't back that up with real concrete data showing your successful business model, it's going to be tough to find that funding. So again, to look at a real world situation here, we'll look at Amira, who works in education tech. She sells preloaded tablets with courses and learning models to educators. And her understanding is that because you're not legally required to close your books at any specific time, that it's not really something that she needs to focus on. And that is true. You're not legally required to close your business at any given moment. The thing is, it's super beneficial to close your business or to close your books on a regular basis. Since her and her team are posting their orders, downloading and posting their orders kind of irregularly, it's leading to some confusion in the business. She doesn't understand maybe why certain things aren't selling very well, or why she's behind on some of her goals for the year in terms of growth. So not having that process in place definitely leads to some confusion. Now, the solution here is she worked with an accountant and built a regular cadence and process for recording and reconciling. So setting up a schedule specifically for posting or downloading and posting her orders that have come in, and a process or a cadence for reconciling either at the end of the month or at the end of the quarter. When it comes to reconciling, we've seen it done any number of ways. You can do it every day if you feel like, but generally the most successful businesses that we've talked to, depending on their order volume and the kind of complicated nature of their books, between every couple weeks and a quarter is generally the kind of the area that you'll find yourself in. But once you've gotten that cadence, you can plan for your growth. Since you have a specific process in place for downloading and posting orders, reconciling and making sure everything is correct across the board, you can plan for that growth over time. And then one way that you can take it a step further outside of just having a cadence there is use an accounting sync software. So much like the inventory sync, you can sync your accounting and download and post those orders automatically, set it on a specific time frame so that you don't have to go in and manually click that button or manually enter sales receipts or anything like that. The software will pull that information from any number of stores that you have and post it directly to QuickBooks for you. All right, now when it comes to expenses, this is very similar to the process that we just outlined with downloading and posting orders and maintaining that record of the transaction. But expenses can be a little bit more complicated because they affect a lot more than just the revenue that you're pulling in, right? Like, you're seeing that expenses are essentially money that you are paying that you're not going to get back at any like regular interval, right? At least not guaranteed. And it affects your bottom line, and that it's something that you have to pay on a regular basis, right? When it comes to either taxes, refunds, payments, your utility bills, as you see in the graphic here at the bottom right. So anything that you're paying regularly that, regardless of if you sell or not, you're going to have to pay, is something to keep track of and something to be very aware of as your business grows. And not tracking these things or recording these expenses in the right way leads to, sort of similarly, the things that we talked about before, having a hard time getting accurate financial records and securing that funding from investors. You're making probably pretty uninformed decisions for your business if you don't know at the end of the day what your total expense is that's coming in. And then when it comes to taxes, if you're not filing or recording your taxes or remitting them correctly, you're looking at possible IRS fines or audits. So again, super important to know at the baseline what sort of expenses you're pulling in versus what sort of revenue you're pulling in, because you're going to need to know at the end of the day how much money you're going to have to operate. So the scenario here that we'll outline involves Bridget. She owns a secondhand bookstore, and she organizes events and does book signings, and it's all the goal to increase foot traffic. So she's eager to get more exposure and awareness with the brand, so obviously she's investing in campaigns and signing contracts for book readings with authors, and she's calculating these costs because these are expenses, right? Like getting these ad campaigns is a pretty big expense, and the authors signing contracts, another expense. But she is neglecting to handle the refunds and the tax remittance properly for her online orders. So she's focusing almost entirely on her brick and mortar and pulling in that exposure for her business, and not kind of taking care of the mundane refunds and tax remittance for those online orders. So not doing that, again, puts you at risks for audits, and having those refunds tracked properly allows you to see what the actual totals you're pulling in are, and kind of avoid double posting and stuff like that. So the way that Bridget can turn this around is working with a tax prep agency like Avalara, a partner of ours that we used to work with a lot more frequently. They can remit and manage your tax compliance for you. And Avalara is not the only company that does this. There are plenty that handle tax remittance, but Avalara is one that we've worked with, again, pretty frequently. So they will take your online orders, and they will make sure that you meet Nexus and that you have all of the documentation that you need to stay compliant. So that is, of course, a paid service. So if you're looking for something a little more scaled down, there are other options to do that. Again, the more scaled down you get, the more manual work is going to be required, but it is generally a good idea to have somebody look at your tax compliance across the board and make sure that you're meeting Nexus in all those areas and kind of remitting correctly. A good thing to note here is that Amazon remits for you. So if you're working with Amazon, you generally don't have to worry as much about taxes, but it is still good to try and record everything that you can to kind of cover yourself, right? So make sure that whatever systems or tools you use, you're able to pull in all the information that you can from your stores, so that you can track everything independently and make sure that you are covering yourself. Again, to take it a step further, you can use Webgility. That's us. I know I've plugged us a lot, but Webgility can manage the expense tracking and pull in any expenses, taxes, anything from your online orders, and post them to QuickBooks for you. So as a kind of a way to scale back from Avalara, if maybe one of those like full encompassed options is too expensive, working with Webgility can allow you to meet Nexus in those areas, or make sure that you're compliant with the Nexuses in those areas, and track all that independently. And for the last scenario here, a big thing that a lot of people have an issue with, or businesses kind of run into, is conflating revenue and profit. So they're not the same thing, right? Revenue is what you have brought in as a total as a business, not including any expenses. And the profit is after those expenses have been deducted, right? So a lot of people are just looking at their revenue as a business and thinking, okay, well, this is money that I have to spend and put back and invest in the business, which is a good thought to have, right? Like getting that revenue in and then using it to scale the business is a good idea. But without knowing exactly what your expenses are and exactly where everything is at in the business, what's costing you money, what's selling well, just having a good grasp on how the business is performing at every level, you're probably going to run into issues where you're either overspending or you don't understand how your cash flow works. So a good way to kind of, I guess, get ahead of this is to start budgeting. And this is something that people can do even outside of business, obviously. Having a budget is a good idea for any person in any situation. But it gives you an idea of your cash flow, and it keeps you within your deadlines for any important expenses or anything that you need to look forward to as a business to make sure that you're not overspending in certain areas. So not having a budget means that you're going to overextend at times in parts of the business, and you might miss those payment or tax deadlines. We all know when it comes to tax deadlines what you're looking at in terms of risk there. So to look at a real life scenario here, Bruno is a distributor of tennis equipment. He sells tennis equipment to outfitters all over the world and uses both drop shipping and in-house warehouse distribution. So Bruno never really set up a budget and doesn't really understand how his cash flow works, and in turn isn't really planning for upcoming expenses. So couple that with the fact that drop shippers are super stringent on being paid on time, and again, the fact that Bruno hadn't accounted for changes in his cash flow or upcoming expenses, this means that Bruno might lose his contract, might damage his distribution network, and might not have a reputation with the supplier going forward. So to kind of combat this, the best way to approach this is work with a financial planner and establish a budget. If you understand how to budget and kind of establish one yourself, that's totally fine. But for those that might not be financially savvy in that way, it's probably a good idea to work with somebody to establish a budget and kind of pair that with channel analytics. Analytics are something that is a super hot topic right now all across every industry, I would say. Data is more important than ever, especially to a growing business. So working with an analytics software that can tell you exactly where your business is at, what's selling well, what's not selling at all, and understand what upcoming expenses and your cash flow at the end of the day is super important. And analytics will help you in obviously more areas than just your cash flow. You can understand, again, what products are maybe selling the fastest, but maybe costing you the less or the least amount. So understanding your cost of goods sold and allowing you to invest in the products that actually make you money rather than just the ones that might sell really well but are kind of expensive to acquire. And as I mentioned before, Webgility does offer analytics as a service, and any of these slides that we've mentioned a solution to these problems. Webgility does offer the solution to these problems. Now, you don't necessarily have to use Webgility. It is just one of the many options out there for when it comes to channel analytics, inventory sync, accounting, like order posting and expense sync. All those things are included in Webgility, but any of the technology out there that offers those solutions will definitely get the job done. And this is a perfect time to segue into our Q&A with Seth David. Again, Seth David is a partner of ours at Nerd Enterprises. He's the chief nerd, and he is here to answer any questions you might have directly related to e-commerce accounting. If it's over any of the topics we covered today, that's perfect. But even if it's maybe a more personal workflow related question, Seth David is a genius when it comes to this sort of thing. And if any of his advice here is valuable to you, he does offer courses and help specifically for e-commerce accounting related businesses. So we'll plug his website as well as ours here at the end of the webinar. But now I'll turn it over to Seth and we can start. Again, any questions anybody has, we'll open it up. No, there you go.
There we go. All good.
Hey, Seth, good to see you.
Nice to be here. Thank you for the kind words. I don't know about genius. I mean, I'm okay.
I think it's adequate.
So what's the most common pitfall I've seen online sellers make personally? The first thing that pops to mind is selling on a single channel, right? And it's interesting because I was having a conversation with Parag, who, for those of you who don't know, is the CEO of Webgility, just recently. And he was saying that actually a surprising number of companies are only selling on one channel, and the channel they're most likely using, you'd all probably guess Amazon. Nope. Shopify, because that's their website. They're selling directly on their website. And the thought is, I'm going to be more profitable. I actually made that exact mistake working with my very first e-commerce client. I just assumed, I was like, anything else has to be more profitable than Amazon, because Amazon charges so much in fees, especially for FBA fulfilled by Amazon, that I thought for sure, it would prove if we looked at the numbers closely enough that Amazon was the least profitable. Turns out, so one of his other sales channels was eBay. And I just, I know how to work QuickBooks Online. So we started going back and kind of coding all his transactions. We already had a group by customer, for each sales channel, but I needed to make sure all the expenses were allocated, in particular shipping. That's really what the kicker was here. When I got all the shipping charges that were attributable to eBay sales, coded to that customer so I could run the P&L by Amazon and eBay side by side. Turns out Amazon was in fact more profitable because the shipping, because he was using this service called Indicia to do the shipping. It just, the shipping cost was so high that that's really what made all the difference. And because Amazon, it's all included, you're paying for all that with them. So I was surprised to see that. But anyway, so single channel, I think, is the biggest mistake. I think you have to be diversified. You have to recognize that by working in an omni-channel system, you create a lot more opportunities for yourself. Yes, it's more to manage, but that's why we need to have apps, to help us manage all that. If somebody's posting stuff manually, the only time I posted stuff manually was when I was first learning how to do e-commerce accounting, and I needed to do it that way so I could really get a deep look at the very ground level of how all this information needed to flow. So I only did it as a learning experience in the beginning, and even then I wasn't actually posting manually. I was getting into each sales channel, figuring out how to pull reports, and then cutting it all up in a spreadsheet, and then using SASANT to do the importing. And then as soon as I understood, okay, this is how everything needs to flow, then I felt adequately prepared to go in and use an app like Webgility, which is in fact the app that I was using with that client at that time, because now I understood how Webgility needed to get set up. I didn't necessarily want to rely on, no offense, John, but I didn't want to rely on somebody from Webgility telling me how to get the accounting set up right. I assumed that somebody from Webgility would know the Webgility app real well, but not necessarily the accounting. It turns out since that I've had a lot of experience where the onboarding people are amazing and they seem to know both very well, at least in terms of the setup. So, is there anything QuickBooks can do to help me avoid the mistakes listed or just be more careful? I think the underlying theme, and John, you pointed this out, was how the one common thread to all of it was manual entry. And that's the answer, is that you should not be entering in 2024. You should not be entering anything manually. Like not anything. At the very least, you're working from the bank feeds, right? So you should never key a number in a transaction. If that's happening, something's wrong, or at least you should look at it and say, what system am I missing? Because that will knock out almost all of those mistakes right there. Because like John pointed out, a lot of it was data entry based. I know, I'm pretty good with numbers, and yet I can transpose numbers. We all do it. We all get dyslexic, especially if I'm tired or something. So the biggest thing to do to avoid, the kind of mistakes that we're talking about here, almost all of them, is to make sure that everything is flowing in. If I have an app that's bringing in all my sales from all my sales channels, I'm not I'm not doing any data entry. Those sales are going to get reconciled through a sales clearing account, then ultimately to payment clearing accounts, if we're talking e-commerce. And then from the payment clearing accounts, after we're dealing with fees, then we finally get to the net amount that's deposited into the bank account. And all of that process, even when I was doing the imports through SASANT, I wasn't keying any numbers. I was downloading it from the sales channel, and then I was cutting up the spreadsheet and then importing it. So I still never touched a single number, even though that process was a bit more manual. Anyway, so that's probably the number one way to avoid those mistakes. Are there any mistakes that are more common for one kind of sales channel or seller than another? Well, immediately my first thought when reading that question is I think of Amazon and how Amazon has a ton of different types of fees. If you ever go into their biweekly settlement report, and I did this because I wanted to understand it, and I downloaded it. The first time I looked at it, it was if you've ever opened it up, it opens up in like a notepad kind of file, and it looks like a bunch of like machine language code or something. It looks like, oh my God, who the hell is going to look at this? Until, of course, I started looking a little bit more closely, and I could see that it was a comma separated value file, which when I pulled it into Excel and then eventually Google Sheets, I was able to cut it up, and then just analyzing all the different columns and studying them long enough to understand what each thing really means. Then I was able to create a pivot table so that in like 30 seconds, I could cut up an Amazon biweekly settlement report and break it down into all the different kinds of fees that they charge by SKU, mind you. And so the big mistake that comes up once I understood all these different kinds of fees is one of the things that will come in there, and it looks like an expense, is the Amazon reserve account. And I've seen so many sets of books that I've taken over where the amounts that are indicated as Amazon reserve were booked as like another Amazon fee. And that's just plain wrong. It's just plain wrong. It's an asset. It's another current asset. It's like an escrow account. Amazon's holding on to some of you or your client's money as almost like a security deposit against future chargeback returns, those kinds of things. So then they're going to maintain that at a certain level compared to your sales. And then each time another settlement report period ends, they're either going to hold back more money based on whatever level they're trying to maintain, or they'll release some funds. And so that one specific component, when you look at their settlement report, if the untrained eye will see it as a fee like all the other fees and book it that way, and it's wrong. It means your balance sheet's going to be inaccurate because you're sticking all that stuff on the P&L. So that's a big one that I've seen. Probably one of the most common things I've seen in particular with Amazon. Shopify is like a whole different animal because Shopify is not just an e-commerce sales channel. It's your whole website, right? So you're building your website on Shopify. Another thing I want to say to speak to really the first question and the third question as far as pitfalls that online sellers make. A big part of developing a sales channel, and this has nothing to do with accounting, by the way, but it's very important, I think, for the accountant or bookkeeper who's serving these people to understand this, is that a lot of making a sales channel successful and giving you as the bookkeeper or accountant a lot to work with, which is the goal, is SEO. And one of the first things I learned from my very first client that I was referencing earlier was, and it came up because I was curious. Curiosity is like your most powerful tool as the accountant or bookkeeper. In other words, you should be asking lots of questions of your client to better understand their business and to better understand the data you're looking at. And what I was doing initially, again, after having done that manual process for a while to really understand what was going on, now I'm trying to like I said, we were using Webgility. So I'm trying to set Webgility up and mapping all the items, the products and services. And what I noticed at a certain point was that he had like 5 or 6 SKUs sometimes on Amazon and on his other sales channels that as I look more closely, I realized they were really all the same one SKU or product that we had in QuickBooks Online. So I had to know that to do the mapping properly. I had to know that these 6 SKUs in web that came into Webgility when I downloaded the transactions, all get mapped to a single SKU in QuickBooks Online. Number one, Webgility can handle that and handles it beautifully. But number two, I asked the client, I'm like, what's the deal here? Why do you have, at first I was like, I had a good enough rapport with the guy that I could joke around a bit. And I was like, you're making my life difficult here. Why do you have so many damn SKUs for the same product? And he's like, because of SEO, because each of those versions of the product is written with different keyword language kind of built in. And he had a guy whose whole job was to write the product descriptions, and he was an SEO expert. That was his whole deal. So I think that's a pitfall, is not putting a lot of emphasis on the SEO and doing and employing strategies like what I just described. And then that's a mistake people make, is not doing that. It's the pitfall and it's the mistake that's very common, that people think, oh, I'll just put up the product in one place with one description and then wonder that it's not selling as well as they expect or hope.
Yeah, that's
And
actually
again,
really crazy good insight. It's something that I, working in implementation, didn't see a whole lot of, because you just think like, okay, well, it's one product, it's got one SKU, that's all I ever have to really worry about. But yeah, working with some SEO experts specifically on the product end has shown me that, yeah, having that diversified, even to go back to your channel comment from the first question, having a diversified sales channel, like a repertoire of different sales channels, is super important from an SEO perspective as well, because you're expanding your reach, you're putting your products in more places, and it's going to set you up for success in the long run for sure.
And I'll tell you why it's especially important for the accountant and bookkeeper to understand. So imagine if I didn't ask that question and I set up the 6 different SKUs in QuickBooks Online and map them in a linear fashion. Now I've got a mess on my hands, especially in terms of inventory tracking. And that's the key. And as the accountant, I have to make sure I've got accurate inventory numbers, because my client's going to ask me about it. And then he's going to want to see a report, and he's going to look at that report, and he's going to see these 6 items that he knows, because he knows his business inside and out, are really the same product. And he's going to be like, I have no idea what my total inventory is, because it's divided up among these 6 different SKUs. And believe it or not, he's going to blame me for not having asked the questions, right? So it's really critical. And that brings me to, I see Omar's question in the chat. And I think it's a perfect segue right into the answer to his question, because he says, I have a physical store. I'm starting a new e-commerce store, and are there any areas that I need to pay attention to from an accounting standpoint, since I serve both online and brick and mortar customers? And the answer right there is make sure your inventory tracking is centralized somehow. So hopefully in your store you have a POS system. Hopefully that POS system, together with all of your online sales channels, are somehow linked to the same inventory management system. Because the worst thing you could do, especially with a brick and mortar store, and I assume that store is going to be used as the warehouse to ship stuff out, except for like Amazon FBA. But even then, you probably bring the products into your store and then ship it to Amazon. Bottom line, the worst thing that can happen is customer calls up and says, yeah, can I get this product? And you say, sure, we've got it in stock. They come in, oh, oops, we made a mistake because our inventory wasn't in sync and we thought we had stock in something that actually sold through one of the online sales channels, right? So that's probably the most important thing to be aware of, is that, and the way I've chosen to come to look at this is, if I have a brick and mortar store as well as online sales channels, the brick and mortar store is just a special kind of sales channel, but it's another sales channel. It's another place where products get sold. And so I have to think of it that way, so I can think of it in the way that I just described. And most importantly, I think, is making sure that my inventory is in sync across every single sales channel in the most real-time manner possible.
Yeah, I like the way you put that, that brick and mortar is just another sales channel, because I mean, it really is. It comes with its own set of expenses and costs, just like an Amazon store would.
Hmm.
It's good insight.
Thanks. All right.
Anybody have any other questions? I mean, we can definitely cut it off here if not. I did want to again just plug Seth's website here, nerdenterprises.com, as well as webgility.com. You'll receive an email with a link to the webinar recording and to both of our websites as well, obviously. And then one thing that I also wanted to remind everybody of, Webgility is running a tax season, because it is our favorite time of the year. Running a tax season special. If you use the code tax season, all caps, all one word, at checkout, there's a 15% off code applied there. So appreciate you guys coming out. We will be doing more webinars, probably more frequently here in the future. So Seth and I already have a webinar on the books for late next month. So look out for an email for that one. If you guys ever have any input or suggestions for topics that you'd like to see covered, drop them in chat here. Reach out to me directly. My email is john.may@webgility.com, or you can just reply to the marketing@webgility email address as well. But again, really appreciate you guys attending. Look forward to hopefully seeing you guys in the future, and everybody enjoy the rest of your week.